Hello and welcome to another Daily Dose of Insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today it's Wednesday, so it's sort of analytical Wednesday. We take a quick look at the charts that move this week, of course powered by our Insights product. Let me quickly share my screen to give you a little bit more guidance on what I'm talking about. We'll start off with our Container Exchange Sentiment Index, where we concurrently ask industry participants how they expect container prices to develop in the near future, in the upcoming weeks. And as you can see here, over the past two to 3 months, we've seen a significant increase in sentiment, so positivity of sentiment overall. Participants expect an increase in container prices. This hasn't really coincided with an actual movement in container prices, so still puzzling why the industry is so overly positive when it comes to rate and price developments. However, here since the all-time high last week, we've seen a significant drop, but of course the index remains near its all-time high, signaling still consistently strong positivity. I'm going to the next page real quick, look at our Insights product. Here we look at leasing container rates. So these are specifically pick-up rates for specific stretches for 40-foot high cubes, ex-Shanghai to, in this case, Chicago and Houston. These are the two blue lines, and Antwerp. This is the green line. And as you can see here, sort of the rates have diverged since March, February, March. And are now sort of closing up again, of course, signaling that the rates here into the US are increasing. Stronger demand for specifically likely SOC containers, Trans-Pacific, to benefit from the current environment there. And then lastly, quick look at other headlines or further headlines of today. Just two significant ones caught my eye. One was that fuel costs are rising. We heard this over the past couple of weeks already, but now they're really hitting the carriers where it hurts. We have the light sulfur oil in Rotterdam, sort of a key benchmark rate at $643 per ton, and that's more than 22% up from June. So in a very, very short time span, fuel rates have jumped significantly. Of course, we don't know how much carriers have actually hedged their fuel costs and have locked in fuel costs at long-term rates, but this is significant. And of course, that's even more significant in light of the rate deterioration. So carriers get squeezed from two sides, top-line revenues fall and costs increase. And this actually also has an impact on variable costs, so transportation variable cost per box. If that increases, then of course the floor that container liners will accept in terms of rates per box for a specific stretch increases, this will likely be above pre-COVID. So let's see what this means for future rate development. And then also a quick focus on Golden Week. That's October 1st to 7th in China. Traditionally a very weak sort of period in container shipping, and typically a period in which container carriers, container liners are pulling a lot of capacity from the market. This year, this pulling of capacity happened on very, very short-term basis. So now still carriers are aggressively blanking sailings. They essentially waited until the last minute because it was almost like a game theory situation where the first mover was afraid to lose. And so that's why they waited until the last minute. And we're now up to 40% of all scheduled sailings that were scheduled to go in the first week of October have been canceled. No respite for rates. To be honest, rates are still significantly under pressure despite this reduction of capacity in week 41, so Golden Week. Cool, that's it from us for today. Thanks a lot for tuning in. Have a good rest of the week. Stay tuned for the Fed interest rate decision tonight. I think it's 7 p.m. UK time. See you all on Friday.